let's talk about a date. January 20th, 2026. This wasn't just a bad day in the markets. It was the day the entire rulebook for the global financial system got torn up. So we're going to break down what happened and why it signals the start of a really dangerous new era. So the first signs that something was deeply wrong appeared before the opening bell even rang. Dow Jones futures were in an absolute freefall, down over 700 points. That kind of pre-market panic, it sends an immediate shockwave through the system. But the real pain, the concentrated damage, was in tech. The Nasdaq was pointing to an opening drop of a staggering 1.6%. So right away, this isn't just a simple sell-off. Something was specifically targeting the very engines of the U.S. economy. Okay, but this is the signal that really freaked everyone out. The bond market. See, normally when stocks get hammered, people rush into the safety of U.S. bonds. That pushes yields down. But look here, yields were surging. They were rocketing up. This was the first giant red flag that the fundamental laws of market physics were breaking. So you have to ask, what was this? Was it just another crazy, volatile day for traders? Or was it something much, much bigger? Was this the moment the market's entire operating system got a fatal error? All the evidence points to a massive, seismic shift. The event that lit the fuse. It was something so bizarre, so completely out of left field, that no trading algorithm on Earth could have predicted it. It quickly became known as the Greenland Ultimatum. And here's the actual announcement. Just let that sink in. Tariffs would be imposed, and they would stay until the United States could broker a deal for the complete and total purchase of Greenland. This is no longer a trade dispute, right? This is using economic policy as a weapon for territorial expansion. And this wasn't just some vague threat either. As you can see, it was very specific. A 10% tariff hitting 8 key European allies, with a clear warning that it would jump to 25% in a few months. And look at that list. These aren't adversaries. They're the core of the Western alliance. This was about applying maximum possible pressure. But here's the really crucial thing to understand. The Greenland Ultimatum, that was just the catalyst. It was the spark. The real problem was that it exposed these deep underlying cracks in the system that all decided to give way at the exact same time.
So, the best way to wrap our heads around this crisis is to look at these 3 things that failed, all at once. First, trade policy just stopped being about economics. It became a weapon. Second, the bond market, the so-called smart money, it went into open rebellion. And third, the entire concept of a safe asset, it just evaporated.
The first failure is really a total collapse of trust. If tariffs can be used to demand another country's sovereign land, then all the predictable rules that global trade is built on, they're just gone. Suddenly, every single trade deal is held hostage by the whims of political decisions. Now, the second failure, you could argue this is the most dangerous one of all. The bond market investors, the ones who lend money to the U.S. government, they started dumping U.S. debt. Why? Well, it's simple. Huge tariffs cause inflation, and endless government spending means a flood of new debt. So the bond markets started demanding much higher interest rates to compensate for all this new risk. And that leads us directly to the third and final failure. You see, for decades, the playbook in a crisis was simple. When you get scared, you sell your stocks and you buy U.S. bonds and the U.S. dollar. It was the ultimate safe haven. Well, on January 20th, that entire mechanism just shattered. This slide just lays out the shift in really stark terms. On the left, that's the old world. Stocks go down, but bonds go up, cushioning the blow. On the right, that's our new chaotic reality. Stocks are down, but this time, bonds are down with them. The US dollar is actually falling, and gold, the one asset that can't be printed by a government, it's soaring. There's literally nowhere left to hide. So what's the end result when you have trade wars threatening to kill economic growth, while at the same time tariffs and massive deficits are fueling inflation? Well, you get the most toxic economic cocktail imaginable. You get caught in the stagflation trap. Stagflation is just the worst of all worlds. The price of everything you buy is going up, eroding your savings, but the economy is completely stagnant. So there are no new jobs, no wage growth, nothing. It's an economic nightmare that policymakers have almost no good tools to fight. So, why does this matter to you personally? Because it strikes right at the core of how millions upon millions of people save for their future. The classic 60-40 portfolio is built on one simple foundational belief. When your stocks go down, your bonds will go up and protect you. But as we just saw on January 20th, stocks and bonds fell together. That foundational assumption is no longer a given. The entire bedrock of the modern retirement portfolio is, at least for now, completely broken. And look, this stagflation isn't just some theory. It's hitting regular households right now. Remember the promise to slash energy bills in half? Well, that collided head-on with reality. Instead, electricity costs jumped almost 7% last year, squeezing family budgets and dragging on the economy even while prices keep climbing. All of this means we have to throw out the old playbook. We need a new rulebook for thinking about the economy and investing. The old forces are being replaced by something new and, frankly, a lot more unpredictable. And if you want to see just how out of touch the old models are, just look at this. It's almost funny. On the exact same day the market was melting down, the IMF comes out with this rosy forecast upgrading global growth. They're saying the AI boom will fix everything. Meanwhile, the actual market, which is always looking ahead, was screaming the exact opposite. So, if the old darlings are out, where is the money actually going? Well, the market is already showing us. Capital is fleeing from those growth sectors, like big tech, which hate higher interest rates and geopolitical risk. And it's flooding into security sectors. We're talking defense contractors, energy producers, and basic commodities. Assets that do well in times of conflict and scarcity. And this all boils down to one single critical point. We are in a policy-driven world now. Full stop. The market isn't moving because of last quarter's earnings report or the latest jobs data anymore. It's moving based on the perceived unpredictability of political leaders and what their next move might be. Ultimately, what really snapped on January 20th was a fundamental law of economics. The market sent a crystal clear message. You cannot fight a trade war, run up huge government debts, and expect the world to keep lending you money at low interest rates all at the same time. It's an impossible trinity. Something had to give, and it did. Which leaves us with the single most important question we all have to grapple with now. In this new era where everything is driven by unpredictable policy, what does a safe asset even mean? When the very governments that are supposed to guarantee safety become the biggest source of risk, where do you even begin to turn?